here and then let Roxanne take it away. So we are pleased to have Roxanne Olenek, a professional accountant, joining us on today's webinar. During the hour, Roxanne will share her insights into business taxes with a variety of accounting, tax, and consulting knowledge. Specifically, she has experience in personal and corporate taxation issues, including reporting requirements for small businesses, record keeping, goods and harmonized tax, sales tax, GST filing requirements, remuneration options, salary versus dividends, for example, and several other issues that new entrepreneurs would typically face. Paying tax is inevitable. However, you do have some control over how much tax you pay. It's a matter of knowing your deductions and being organized. So thank you, Roxanne, for joining us today. Please note that Roxanne will do her best to answer all your questions after the presentation. If she missed your question or cannot answer it due to time restraints, we will post the answers on our website alongside the recorded webinar. Roxanne, please start whenever you're ready.
Great, thank you very much for that introduction and welcome everybody. Really nice to see a good turnout today. And I'm looking forward to this presentation. So kind of as my introduction had stated, my name is Roxanne Olenek. I am a chartered professional accountant with MNP. I'm located in the Saskatchewan office. My contact information is up here, so again, if you do think of any other questions or if you want to reach out to me outside of this webinar, please feel free to email me, you can call me, you can also connect with me on social media. So before I hit the agenda, I just want to do a brief overview about MNP in case you are unfamiliar. So we are a national professional accounting firm, and these numbers are recent. We have grown to become the 5th largest firm nationwide with over 60 offices and just under 4,000 team members and 650 partners. So that being said, if any questions are asked today and I am unable to answer, trust me when I say I'm sure I can find someone who will be able to get the answer to you, and we can always follow up after the presentation. Just a brief overview of the different types of clients that we service. So you'll see private enterprise, that would encompass, small businesses. Of course, we have a wider range of clients. I have experience dealing with a wide range of clients, so we definitely have the expertise here to help you. Just a brief look there. And with that, we'll dive right in. So the objective today, kind of as laid out, is just to help you understand how taxation works for your business, and also just to provide you with some tips to make the filing process easier for you as tax time is coming up for the 2016 year. So it looks like a daunting agenda, but I just wanted to lay out everything that we hope to cover today. First, we're going to take a little look at business structures and how your business might be structured from a tax point of view. Of course, the question that everyone is always asking, should you incorporate your business? We'll touch on some advantages and disadvantages of that. Then we'll look at business profits and how they are taxed depending on your business structures. Moving into some common business expenditures such as capital cost allowance or CCA for taxes, automobile expenses and what you are eligible to claim, home office expenses, the rules around that, and if you are eligible to claim that as an expense as well. Then we'll touch a bit on some income splitting and how that might be an option for you and your business. And then we will wrap up with just some administrative items around tax regulations, who you should be registering with, deadlines, some helpful tips, and so forth. So again, as mentioned, I'm going to try and move through all of the information in respect of people's time in case that you have to get away after 1 p.m. If time permits. Of course, we will answer questions at the end, and if we run out of time, I'd be more than happy to handle your questions outside of the webinar. So first things first, business structures. Essentially, there's 3 ways that your business can take shape from a tax perspective, and I will cover each briefly. There's a sole proprietorship, a partnership, and a corporation. So a sole proprietorship would be if you started a business tomorrow and you didn't do anything in terms of incorporating, you just reported your income personally. So it is an unincorporated business. You would just report all the activity of that on your personal T1 tax return. A partnership, in simple terms, really is like a sole proprietorship, except there is just more than one business owner or partner. And then finally the corporation, which we will touch on in a little more detail as we go. It's an actual separate legal entity, and it is separate and distinct from the owners or shareholders in that corporation, and for tax purposes has the same rights and responsibilities as a person. So first, let's take a look at the sole proprietorship. Again, what the majority of most startup small businesses will be. Some of the advantages to which, a lot of years, in the first few years that you start a business, you may be incurring some losses. This is not unusual. The advantage to that from a tax perspective is if you are a sole proprietor and you are also earning employment income, so if you receive a T4 from an employer as well as run a small business on the side, you can actually use the losses that you report from your business to offset your employment income, which will reduce your overall personal tax bill. So this can be, if you want to look at it that way, as an advantage. Administrative-wise, it's lower administrative costs. You know, you're not required to file with Information Services Corp, your corporation, lawyers' fees every year to have directors' resolutions, the costs to file a separate and extra corporate taxation T2. So that's another advantage when you just stick with a sole proprietor. Again, though, some of the disadvantages, of course, which we will talk about in a bit, is you aren't able to take advantage of the small business rates. If you are a CCPC, which is a Canadian Controlled Private Corporation, if incorporated. And then also you carry that personal liability. So if you have a loan or if you have any kind of leases and those kinds of things and you default on those, the creditors can come after you personally. So that would be your personal assets and that sort of thing. So something to keep in mind. So as a sole proprietor, how much tax do you pay? So sometimes income tax look a little confusing. I have for the 2016 year, as that's the tax year that we will be working with coming up here with tax season, but as well for this year, you'll see that there's a slight shift in the income brackets, if you will, and that's really just indexing that CRA typically will do. This has changed in the last couple of years. There is now a higher tax rate for incomes that are $200,000 and above at that 48%. But essentially what you need to know here, if you look, if you are earning from your business personally less than 11.5, you're not paying any tax. From 11.5 up to about 45,000, you can expect to pay in that 26 to 28% range. Then from the 45,000 to 127,000, the 28 to 39% range. And then once you hit above 127,000, you start to get taxed at those higher income rates. So the highest rate being 48%. On top of that, as a sole proprietor, you will be responsible for both the employee and employer contributions. So typically if you work for a company, you receive a T4 as employment income. That employer is responsible for remitting your CPP and taking that deduction off of your paycheck, and then they remit their matching portion as well. However, when you have your own business, you are required to do that, or else if you do not, you can be assessed by CRA and be assessed penalties. So for the 2016 year, for any salaries paid, you will pay 9.9% on income in excess of $3,500 to a maximum of $54,900. So a total in premiums of $5,089. The thing that's a little bit different is that you have the ability to choose if you want to pay employment insurance premiums. So you aren't required to, but there are a few things to take into consideration for that. I won't elaborate on them too much, but as a sole proprietorship or having a small business, if you are paying into EI, it will help cover you in the event that you want to have maternity benefits. There are parental benefits available. Again, sickness benefits, so if you are unfortunately to fall ill or have an injury, then EI can help you there. Compassionate care benefits, and then benefits as well for parents of critically ill children. So it is, as it's stated in employment insurance program, it's really just at your discretion then as a proprietor if you are going to be paying those premiums. So again, what are you paying tax on as a sole proprietor? So that will be your business profits. So if you want to think of that as the amount of income that you earn, less any eligible taxable expenditures, you're going to have that either. You'll have a profit. If you have a loss, you will not pay tax on that. But if you have a profit, that is what you will be paying tax on in those brackets that I outlined a few slides back. So if this is your first year of your business, As a sole proprietor, your tax year will be the day that you start operations to December 31st. And then in years after that, you will have a year running just from January to December 31st. So the same as for personal taxes. All personal taxes, sole proprietor business earnings must be paid by April 30th. If that day falls on a Saturday, typically CRA extends that deadline to the next working day. But to keep in your minds and to add on your calendars, April 30th is usually that hard deadline. It's important to take note of installments. So depending on your business situation, if in the previous 2 tax years you had taxes owing of $3,000 or more, you will be required by CRA to make quarterly installment payments. And for sole proprietors and personal income, the CRA will advise you of the amounts to pay. But really, you can also calculate that on your own. All that it will be is the previous year's taxes divided by 4 for each quarter, and that is what you could expect to pay in quarterly installments for the year following. So already for the 2016 year, your installments should have been made, so this is to keep in mind for the 2017 year if you need to make those quarterly installments. And when are they due is probably what everyone was wondering. Well, they are due each quarter on the 15th day, so March, June, September, and December 15th. And it's really money just being thrown out of your pocket if you don't meet those deadlines, because you will be charged then either installment interest, as well as you can have failure to file penalties, which I'll touch on a bit later, for outstanding taxes owing. So the next business structure, that was the sole proprietor, is that partnership. So I briefly touched that it's essentially like a sole proprietorship, except that you have more than one partner within the business. Some advantages of which, basically the same ones that I had laid out for the sole proprietorship. You can use, if there are losses, you can use that to offset employment or other types of income. From year to year, you can have the ability to choose how you want to split the profits of the business with your business partners. So in one year, you might do it 50-50, but perhaps in another year, one partner might be putting in more work or more equity than the other, so they might take a greater percentage of the profit than the other. You have that discretion on an annual basis to make that decision. Some of the disadvantages, again, is that personal liability that I talked about. If there are any defaults, creditors can come after personal assets that are owned. And of course, you have to always keep in mind, if you're going into a partnership, you have another partner or partners to do business with, which can result in disputes from time to time. So it is also important to always, if you are in a partnership or considering going into a partnership, to make sure that you have a partnership agreement drafted in the event, unfortunately, that something is to go awry. So again, as I had mentioned, you have the ability to choose how you wish to split up that share of profits, but something to keep in mind, you have to make sure that the allocation is reasonable. So if CRA was to go and take a look, it should be reasonable in their eyes, being that you can't be paying profits of 80% to a partner who really did nothing or didn't put any equity into the business in a year, just so that you can shift income around. So make sure that you are taking into account, as mentioned here, how much capital each partner is investing, and also the effort or the sweat equity that they are putting in the year. And then finally, the third business structure, the corporation, which we will dive into a little bit in our next section on the benefits and disadvantages of incorporating. So advantages, as mentioned with the other two structures, you don't have limited liability. With a corporation, generally you do, because it is treated as a separate legal entity. That will mean that, again, if you have a business loan through your corporation and you were to default or the creditors were to come after you, due to that default, they can only go after the assets that are owned by the corporation and not you personally. However, it is important to note that for a lot of startup businesses, you will be required to put a personal guarantee on a lot of loans that you take, so then the limited liability does not apply. So do keep that in mind. Definitely something to consider. Corporation, an advantage is favorable tax rates. So profits under $500,000 currently, the small business rate is 12.5%. But again, you have to realize that's for profits earned within the business. If you are pulling that money out as salary, you will be taxed on it. I'll get into that later. So then you really aren't benefiting from a favorable tax rate. But if you are reinvesting the profits within the business, you do benefit from that lower taxation rate. Again, kind of as the overall theme of this presentation has said, you aren't able to avoid taxes, unfortunately. You will always be liable to pay taxes. However, you generally will have an ability to defer taxes when you have a corporation. And again, that is by keeping profits within your corporation instead of withdrawing them personally. I also have there that there are potential tax advantages on the sale of a corporation, a little bit beyond the scope of this presentation, but that goes into the capital gains exemption. If you have questions on that, I'd be more than happy to answer them outside of this webinar. And then just some disadvantages, higher administrative costs. So again, Information Services Corp, you have to be filing annual information returns with them. You'll have to be filing with a lawyer director's resolutions every year. You have to be filing a corporate T2. So there are more administrative costs from that perspective, which can add up to a lot as a small business owner and is something to keep in mind. You have limited use of losses. So as I explained earlier, if you are incurring business losses as a sole proprietor, you can apply them against other employment income if you have. However, with a corporation, losses are only kept within the corporation. So you couldn't take a loss from your incorporated business and apply it against your personal income. You can't do that. So unfortunately, that would be a disadvantage. You can carry those losses. However, you can carry them back 3 years and forward 20. So I won't get too much into that, but do keep that in mind, that they're not completely lost if you're not able to apply them in the year that you incur them. And as I had mentioned, there is that whole advantage of limited liability. However, a lot of instances, small businesses, you're going to be required to put a personal guarantee on your financing, so that offsets that limited liability advantage. So corporations, how much tax do corporations in Saskatchewan pay? Well, for 2016, as I had mentioned, the rate used to be 13 and it's been reduced to 12.5% on the first $500,000 of active business profits. Once you exceed that $500,000 of profits, and again, that's not revenue, that's your revenue less your expenditures is your profits. When you exceed that $500,000, then the tax rate begins to go up to 27%. And then also keep in mind any inactive income that you're earning, so rental property income, any dividends or interest on investments, those kinds of things that are a passive type of income, they will be taxed at a higher rate, which has also increased recently, and that's 50.67%. So that is for 2016. So a little bit different from a sole proprietor for some elements of tax. You are still paying tax on the profits for your fiscal period, which again is the revenues that a business earns, less eligible expenditures from a tax perspective. However, the nice thing about corporations, rather than running that January 1st to December 31st year, you can select any year end that you want if you incorporate. And this can be helpful because you can match it to the cycles of your business, and you can have your year end at a slower time. So, for example, the first thing that comes to my mind, say you have a you-pick strawberry farm. Well, I think your busiest time of year would be in the summertime, so you probably don't want to be dealing with like a June year-end or a July year-end. Rather, you might push that year-end to October when you have a slower time and have more time to deal with your books and those kinds of things. So there is an advantage to that. When you have a corporation, you, again, don't have to follow that January 1st to December 31st rule. When must a corporation pay tax? This is important to understand. If you have a balance owing or you earn profits and have to make a payment of tax, it is due for Canadian-controlled private corporations, which are most small businesses in Canada where Canadian residents are the shareholders, within 3 months of the end of the company's year-end. So for simplicity, if you have a December 31st year-end, you would need to make any tax payments by the end of March. Tax returns, if for whatever reason you don't have your tax return finished, but you know you're going to be owing, those must be filed with a hard deadline of 6 months. So if you had a December 31st year end, then your tax return would have to be filed with CRA by the end of June. And again, similar to personal or sole proprietorship, quarterly installments will be required if in the previous taxation year you had more than $3,000 in taxes owing. And again, this is due at the end of each quarter, not on the 15th, but at the end of the quarter, as was the case with the sole proprietor. For this one, CRA does not send installments as with personal taxes. And again, it's really just throwing money way out of your pocket if you're not making those on time, because you will incur interest charges if you do not make those installments or if you do not pay your tax within that 3-month deadline. And that amount is on a compounded daily basis, so it can definitely start to add up. So the next thing to look at is, if you are incorporated, how can you get that money or profits that your corporation is making into your hands personally? So it's very important to note, this is an important slide, as a shareholder, you can't just take funds out of an incorporated company or assets from the corporation without accounting for them personally on your T1 return. If you do, if you are assessed by the CRA, it can result in very significant penalties. So for lack of a better term, please don't do it. In some situations, the amount may be taxed personally with no deduction to the corporation. So that's important to keep in mind. You can't just withdraw money from your business and not be accountable for it on a tax perspective. So again, I had just kind of outlined that here. There are some limited circumstances with shareholder loans that we will touch on in a bit, but those usually will also have a deemed interest benefit being charged on them, which is currently 1%. So valid payments to shareholders, there is essentially 3 of them. As a corporation, if through incorporation there was tax planning done and you have a shareholder loan with your corporation, that could be repaid back to the shareholder tax-free. But there's situations around that, and I'd be happy to discuss those again outside the webinar. I won't dive too much into them. Salary, which is quite common in a corporation. So again, as we talked about before, there will be income tax and CPP. EI will not be subjected to the shareholder if they own greater than 40% of the voting shares of the corporation, so that's something to keep in mind. And also you can't decide to change your salary to a loan repayment at the end of the year, just based basically on tax saving perspective based on court precedent that's happened in the past. Finally, the third payment is dividends. So a lot of people ask, should I do salary, should I do dividends with my corporation? So dividends are different than salary in that they are not deductible to the corporation. They are after-tax dollars. So they're not an expenditure on your company's income statement. It's after whatever residual dollars there are to distribute to you as a shareholder. And again, you are responsible personally to report that on your T1 as dividend income. So again, salary and dividend, the profits that are earned in the corporation are taxed at that 12.5%, but as soon as you withdraw any money from the corporation as salary or dividends, you are required to report it personally, and effectively you then are still paying a high rate of tax. So as indicated, you cannot avoid tax. You can defer it if you keep the profits within the corporation at that 12.5%, but as soon as you withdraw those from the company, then the personal tax will hit that on your personal tax return. And also important to note, dividends do not form part of earned income for Rrsp purposes. So for your registered retirement savings plans, if you're making contributions to that, it will be based on a calculation, and any dividends that are paid to you as a shareholder will not be included in those calculations. So again, something you would want to talk about with your investment advisor or your accountant. So again, I kind of touched on earlier, do you want to pay a salary or do you want to pay a dividend? A common question asked. Usually it's recommended that you pay at least a little bit of salary if you are eligible and want to be making Rrsp contributions, so that you have that employment income to form part of the calculation for what you are eligible to contribute. So really it'll depend on individual circumstances, but typically, usually a little bit of salary is good for that. So then just kind of a recap about the salaries and dividends like we talked about here and the income brackets that I touched on earlier. You'll see that the tax rates will differ for dividend income and salary. And then as well, there is capital gains income, which I haven't really touched on, but again, if you think that's something that will impact you, feel free to touch base with me afterwards. All right, so there's business structure. That is the biggest topic. The rest are a little shorter. So we'll move into the question of whether or not you should incorporate. So if you are operating as a sole proprietorship or partnership right now, this might be a question that you are considering. And of course, it will depend on your individual situation. But as mentioned previously, the major tax benefit behind it is the tax deferral that you receive. Again, you're not avoiding that tax, but if you are keeping it within the corporation, it's only 12.5% compared to upwards of 48% if you're reporting that business profit personally. And then, as I mentioned, on the sale of small business shares, capital gains may arise. You have a lifetime capital gains exemption amount. Again, we can talk about that if that's something that impacts you. Essentially, For startup and small businesses, the question on incorporation, it really only makes sense if you are being taxed at either the middle or higher income tax brackets. So if your income range, as we had touched on in the previous slide, is within that 0 to 28% lower income brackets, it won't make sense per se, but if you start being taxed at those higher brackets, it will, because then you can take advantage of that tax deferral and that lower tax rate. So another question is, in order for you to take advantage, or I shouldn't say a question, another thing to consider is, in order for you to take advantage of those small business rates, the funds that are taxed in that corporation have to remain in it. So if you have a corporation and any of the profits that are made, you're simply withdrawing every year as a salary or dividend, then it doesn't, in order for you to, make a living and pay for your personal expenses, it doesn't make sense, because as I had kind of alluded to earlier, funds within the corporation are taxed at 12.5%, but again, as soon as you withdraw those as a dividend or a salary, you have to pay personal tax on them. So the combined 12.5% that you pay corporate, as well as the personal income tax that you will be paying on that, depending on which bracket you fall in, essentially adds up to being the same amount that you would be paying roughly personally. So there is no benefit then. So it's something to consider with how much profits your business is making and how much you're actually keeping and reinvesting in your business and how much you need to withdraw out to live. That's the most important thing I would say to consider when you are determining whether or not you want to incorporate. And again, in the first few years of small businesses, in a lot of instances, you might be incurring some losses until you get, up and running and get a little more well established. So remember that those losses, when you are a sole proprietor, you can use against other forms of income, which is a huge advantage. So in a lot of instances, when you're starting off, it might make sense just to stay as a sole proprietor until a time down the road when it makes more sense for you to incorporate. But again, that will really depend on your situation. There isn't a one-size-fits-all explanation for that. So a question that we will see a lot is, if I start unincorporated as a sole proprietor, as you would if you weren't to register a corporation, can I decide to transfer my business to a corporation later? So what if I decide to open a business and I'm a sole proprietor for 3 years, and then can I incorporate in my 4th year? Yes, absolutely. And that's why I said in a lot of instances it makes sense maybe to stay as a sole proprietor in your first few years until you are ready to incorporate. It's quite easy to do, and it can be done with no immediate tax consequences usually. So to answer that question. However, on the flip side, if you get a question, okay, what if I start a business and I incorporate right off the hop, and then a few years down the line realize that I would sooner operate as a sole proprietor or an unincorporated business? Can I do this? You can do this, but caution, because it can be a rather costly conversion from a tax point of view, dissolving your corporation and all of the assets held within the corporation, taking them to personal. It can get a little messy. So this is important to keep in mind. You'd be better off starting as a sole proprietor and then deciding to incorporate, rather than incorporating off the bat and not even really needing to, and then wanting to switch back to the sole proprietorship afterwards. Okay, so next topic is just a little bit on business profits. What is a business profit for tax purposes? So the general rule of thumb, a business can claim all expenses incurred for the purpose of gaining or producing income. So if you need to pay for that expense in order to run your business, it is likely, in most cases, deductible for tax purposes. There obviously are the one-offs, but that's kind of the general rule you should always be following in the back of your mind. Can I deduct this for the business? Well, did you need to spend it in order to earn income or to run your business? That'll kind of help guide you in the right direction. So from a tax perspective, you always start with your accounting income that you would have from your record keeping or your bookkeeping, and then you make those adjustments for tax purposes as required. And it's also always important to remember, for expenses, they have to be considered quote-unquote reasonable. So one way to think of that is, if you were to be selected for an audit, how would CRA come back and view reasonable? Would they see that the expense that you incurred for your business as reasonable, and that other businesses like yours would be making those kinds of expenditures? So some common adjustments we can just go through for tax purposes of expenditures that you will see. So donations are a little bit different whether or not you're a sole proprietorship, partnership, or an incorporated business. So donations, when you are a sole proprietor, are not actually deductible as an expense in calculating business profits. Rather, they are claimed on your personal tax return as a tax credit, so that's important to keep in mind. For an incorporated business, your claims are limited to 75% of the net income of the corporation, so you can't be making donations exceeding your net income. Political contributions, so if as a business you are making contributions to a certain political party, they are not deductible as a business expense for tax, so you can include them, as your expenditure on your financial statements or in your bookkeeping for accounting purposes, but when you go to do your tax return, they actually are not considered deductible. If that contribution is made, you might be entitled to a tax credit depending on the circumstances. Club dues, so when you're thinking like golf club memberships or memberships to sporting or recreational facilities, those are not deductible for tax purposes, so if you incur them during the year for your business and you deduct them from your revenues for business purposes on an accounting basis, you have to add them back when you go to do your tax return, as you cannot use them to, effectively lower your taxable income. Now the big one that everybody is always asking is meals and entertainment expense, a very common expense, but it can always become a bit of a gray area and questioning whether or not it's considered a business meal and entertainment expense. So general rule of thumb is that only 50% of those expenses are actually deductible for tax purposes, and that includes the GST on those expenditures as well. And you can only deduct meals and entertainment expenses if they are needed in order to earn income, or if you have incurred those expenses while earning income. So, for example, I know my brother has his own small business corporation, and it seems like I'm getting texts from him every day asking if certain meals and entertainment expenses would qualify. And I usually just tell him, you know what, when you're in doubt, it's probably only 50% deductible. It's always going to be 50% deductible, and when you're really in doubt, it's probably not an eligible expense from that perspective. Because he says to me, well, I buy lunch every day when I'm at work. Does that count as an eligible business expense? No, likely not, because you would likely be buying lunch in some form or another, whether or not you had a business or not. So it's kind of just that general idea behind whether or not you really needed to do that business lunch in order to do business and to earn your revenues. So it's that 50% important to remember. All right, another one that commonly will come up, if you are not making your quarterly installments, and if you are not making, your balances owing paid on time, and the CRA does assess you interest or penalties, you cannot use that as an expense to lower your taxable income. So you will have to add that back when you're determining your taxable income from your accounting income. So that's set in stone by CRA, so that's also something to keep in mind. So on those notices of assessment, if you're entering, $100 in late filing penalties because you didn't file your GST on time, you can't use that as a deduction to create lower taxable income. You'll have to add it back when you go to do your taxes. Another common adjustment is depreciation versus capital cost allowance. So depreciation is on an accounting basis, and it does not necessarily mean that it is going to be the same as your capital cost allowance or CCA. CCA is essentially like a depreciation for tax purposes. Oftentimes those will differ. So it's important to keep that in mind when you go to do your tax returns. So I'll actually touch a little bit next on capital cost allowance. So you'll see here basically how it works is, like I said, it's like a depreciation for tax purposes. CRA has asset pools that are kind of based on just the description of what the asset is, or classes I should say, and they have prescribed CCA rates that you use. So for example, many small businesses will perhaps have computer software, so if you have a computer it would be class 50, so each year the cost of which will have a CCA rate of 55%. So generally computer and computer software will be fully depreciated for tax purposes within 1 to 2 years. Another common one would be furniture and fixtures. Those go into what's called class 8 and have a CCA rate of 20%. Vehicles are class 10, 30%. Another very common one. Something new for 2017, not as common but something to keep in mind, is eligible capital properties. So starting in the 2017 year, not implying for the 2016 year, there's an actual new asset class for it. It used to be called CEC, or Cumulative Eligible, I can't think of it right now off my head, Capital. So eligible capital property starting in 2017, that'll be things like the cost of incorporating. You can actually capitalize for tax purposes as eligible capital property. If you do, depending on the nature of your business, have things like customer lists, patents, trademarks, those would all fit into this new asset class. So most CCA classes are calculated on a declining balance method, so different maybe from depreciation. If you're doing a straight line method just over X amount of years, this will be done on a declining balance method, so you just are taking whatever your balance is at the end of the year and applying that rate as it continues to diminish. And as I had just mentioned in that previous slide, all assets will fall into a particular class prescribed by CRA with a CRA rate. Most additions are subject to the half-year rule, which I'll touch on in a second. And if you have a shorter year end, so if it's your first year and you incorporate partway through the year, any CCA that you would claim would then be prorated based on the amount of months out of the total 12 months in the year end. So when you actually go to remove of any company-owned assets or dispose of them, you have to remove them at the lower of cost and proceeds. This is important in terms of calculating taxable capital gains when you remove them from an asset pool. If for whatever reason you were to dispose of all assets in a CCA pool, so if you sold all of your furniture, for example, in Class 8 and there was nothing else sitting in that asset class at the end of the year, you may have to deal with things that are called terminal losses or recapture. That would also be accountable on your tax return. I won't dive into those too much because they can get confusing, but if you think that is something that would apply to you, I'd be happy to go into detail with it more with you after. So let's just do a quick little example just to kind of touch on what I've just talked about. So if you're looking at CCA, for example, this company's year end is December 31st. They purchased a photocopier on November 15th for $3,000. The year of purchase half rate rule is going to apply in a Class 8 or 20%. So even if it was purchased almost at the end of the year, it's still just going to be that half rate rule, meaning that you would only put $1,500 into that Class 8 pool in the first year and take that 20% CCA deduction. So here it says in the first year $300, and that's just calculated again by putting that $1,500 or half of the cost into that Class 8 and timesing it by that 20%. So $1,500 times 20% would equal a deduction for tax purposes in that year of $300. The following year, you would add in that remaining $1,500 that you hadn't added in the first year due to the half-year rule. So you would take the diminished amount of the original $1,500 less that $300 CCA for that $1,200. You would add on that extra half, that $1,500 in your second year. So then your CCA pool would be $2,700. Times that by that 20% rate, then your CCA in the second year you would claim would be $540, and it just goes from there. So just kind of an idea to show you how that half-year rate or that half-year rule works when you're calculating CCA. And depending on your tax software, generally that will automatically calculate for you. Next slide. I won't dive in too much of this, but when you do decide to incorporate and go from personal to business, if that is something you choose to do, if you are reporting on your personal return for your business assets that are owned and taking CCA on them, there are some tax implications of transferring them or rolling them into your corporation, and that will require determining what the fair value of those owned assets are. And in most instances, we would recommend professional advice or guidance on that because that would likely require what's called a Section 85 rollover. But again, I won't dive into that. Just something to keep in mind if you are thinking of incorporating. All right, next up for another common business expenditures are the automobile expenses. So wouldn't that be nice if all of us could drive a car like that? I just thought I'd put a really pretty car in there, but obviously not the case. But something to keep in mind, if you are a sole proprietor and you are unincorporated, you are eligible to claim a business portion on your automobile expenses if you are using that automobile in order to operate or run your business to earn income. And the eligible expenses of which I have listed out there. They include gas, repairs and maintenance, licenses, insurance, if you have a car loan, the interest on that, if you have lease payments on it, as well as if it's owned, the CCA, like kind of we just previously touched on that automobile. Now, incorporated, you'll notice this changes from the last slide. If you have a corporation, you have 3 options generally with automobiles. The first option is that you can keep your vehicle in your personal name and then get reimbursed by the corporation on a kilometer basis for business use. So similar if you were to drive, for your employer, if you were to drive your vehicle and then claim mileage if you did a business trip for whatever reason. Similar to that, you can just do it for the year, and there are CRA prescribed rates. For 2016, for the first 5,000 kilometers that you drive your personal automobile for business purposes, it's 54 cents, and then thereafter it is 48 cents. And this reimbursement does not have to be included in your personal income. However, it is not deductible to the corporation. The second option would be, again, to keep your vehicle in your personal name, but instead of being reimbursed on a mileage basis, you would just be paid a flat monthly allowance for the business use of your vehicle. This is different from option 1 in that it is deductible to the corporation, and that allowance that you receive would be included in your personal income. So similar to if you worked for an employer and you received a monthly vehicle allowance, you would have a taxable benefit on your T4. But again, you can use auto expenses against the income on your personal tax return, so that's something to keep in mind for the second option. Third option, if you are an incorporated business, is that the company owns the business, so you purchase the vehicle in the company's name. If you do this, then the company can claim operating expenses and that capital cost allowance, that 30% a year, on the vehicle as taxable expenses that can reduce business income for a lower taxable income. However, if you do this, then you would have to calculate a benefit in your personal income if the vehicle is available for your personal use. So there's things called standby charges and operating benefits from that perspective. I won't get too much into those, but they can add up depending. So this is something to keep in mind. It'll really depend on what your business is and what you need to use your vehicle for when deciding which of those options would work best for you. So some general guidelines to keep in mind. You should keep a log. CRA always recommends this. I know this might be tougher than it might look just to type that out. It can be a little bit arduous over the year, but in theory you should be keeping a log to support what is business and what is personal should you ever be audited by CRA. As I touched on earlier, there are some limits for these expenses. So capital cost allowance, if you do purchase a vehicle in the company's name and want to claim CCA on that, it's limited to $30,000 plus GST and PST. So if you bought a car over $30,000, such as that pretty little Lamborghini a few slides back, you would only be able to put that $30,000 into that Class 10 asset pool for tax purposes. Interest expense, there's a limit as well. So if you are paying interest on payments, it's limited to the lesser of the total interest paid and $10 times the number of days for which the interest was paid. So just the lesser of those two. If you are leasing your vehicle, lease expense is limited to $800 a month plus PST and GST based on the lease signing date. So if you're exceeding that $800, you can't claim that as an eligible expense. You would have to add that back. Home office expenses. So if we look here, a lot of people who have small businesses operate out of their homes. So this is a really important one I think to touch on and something to keep in mind for you as you go with your taxes. It'll depend on whether or not you're incorporated or unincorporated. So if you are a sole proprietor or an unincorporated business, to claim there is a test that you must meet, and if you are ever to be assessed by CRA, you have to be able to defend that. So I've listed it out here. The workspace must be your principal place of business, or that workspace in your home is used exclusively for the purpose of earning income from the business and is used on a regular and continuous basis for meeting the clients or customers of your business. So one of those two tests has to be met in order for you to claim a home office expense. You know, you can't just decide that your kitchen table that you sometimes will do a little bit of work on from here and there is going to qualify and then try and claim home office expenses off of that. So important to keep that in mind. On the other hand, if you are incorporated, it must be the principal place of business. And then from there you have to determine what amount that your home is used for business use and then charge it to the corporation. And wouldn't it be nice if we could all just sit at our desks, always enjoying a nice little cup of coffee? I wish I had more time to do that. So if we just want to do a little recap, home office expenses, they do differ depending on whether or not you are an employee, a commissioned salesperson, or if you are self-employed, so something to keep in mind as well. Certain home office expenses are eligible, others are not, depending on which category you fall into. So if you are self-employed and you have a small business, all of them, if you qualify for the home office expense, are eligible for deductions. But you'll notice for employees, they can't claim home insurance, property taxes, mortgage interest, or CCA, and mortgage interest and CCA cannot be deducted for commission sales people. So as I mentioned, that home office expense that you're going to be claiming is limited to the business use. Generally, this is based on square footage. So just, you know, if you're using 100 square feet in your home, and it's a 1,200 square foot home, you would just take the percentage of which, and then you would be able to, all the expenses that relate to that based on that percentage. It's important to note, though, that if you have home office expenses that you are claiming to reduce your income, you can't use them to create a loss. So, you know, if you had $100 in profits and you had $150 in home office expense, you couldn't then incur a loss of $50. You would be limited to that $100. However, that extra $50 you could utilize in future years, and you could carry it forward. So keep that in mind. It's not totally lost. You just can't use a home office expense to incur a loss for tax purposes. And then finally, I just wanted to touch on income splitting. So this is another common question that we receive. Why would you want to do income splitting? First of all, what is income splitting? So that is when you are splitting the profits from the business, perhaps with your spouse or another family member. Why you would want to do that is to allow to allocate income to family members who might be taxed in a lower tax bracket. So rather than one spouse, for example, reporting all of the income from the business and paying a high rate of tax, why not split some of that income with the spouse so that you can pay both in the lower tax ranges and effectively pay less tax than you would if it was all in one spouse's name. How is this achieved? Well, you can pay salaries to family members, but be careful because this is generally scrutinized by the CRA. It's not that it's not allowed, it just has to be, again, that whole reasonable, quote unquote. So again, if somebody were to own a coffee shop, they couldn't take the salary of $30,000 and pay it, say, to the husband or wife who actually doesn't really have anything to do with the coffee shop and works not at the coffee shop but has their own place of income. You wouldn't be able to do that. If the RA came back and saw that, they would say, okay, well, what has this spouse actually contributed to this coffee shop in the year, that kind of thing. So it has to be defendable. It has to make sense. It has to be, that salary has to be paid for actual services provided by the individual. Another element, if you are incorporated and you have that option then with shareholders to allow for the payment of dividends. So that is another opportunity to consider if, say, husband and wife or spouse and spouse are shareholders in the company. There are opportunities then to pay out dividends to each shareholder to, again, kind of split out that income for a lower tax rate. So finally, I'm just going to quickly zip through some administrative items and tips to help you just to keep in mind as tax season approaches, and then hopefully we'll have a few minutes to take a look at some questions. So administrative matters, tax registrations that you should be registered with, and if you aren't already, something definitely to keep in mind as a small business. The Canada Revenue Agency, so you'll need a business number registration, and there's actually 3 here. So you'll need your GST registration number, as well as payroll and corporate tax accounts. So that you'll see that being for corporate RC is what it is after your business number, payroll is RP, and GST is RT. Provincial Sales Tax, so for those in this webinar that are in Saskatchewan, that would be with the Government of Saskatchewan for PST. Again, you would file your PST through, it's called SETS, S-E-T-S, online. And then also you want to make sure that you are registered with Workers' Compensation Board if that applies to your business. And for more information on that, I would recommend checking out their website, but there are certain industries that are required that the employees do have workers' compensation, so it'll really depend. So I won't dive too much into GST, PST, as I feel that could be a whole presentation in itself, but to keep in mind, GST is generally filed quarterly. You can elect to file monthly or annually, depending on certain circumstances, but the general rule of thumb would be quarterly. Payroll, source deductions for employees. You're required to, again, withhold and remit that income tax, as well as CPP and if EI from the salary payments. So that is now your responsibility if you are a small business owner. and it's important that you remember to remit those monthly to the CRA. And also important to keep in mind if you have employees, the deadline for T4s is February 28th. Source reductions, again, is the 15th of each month. So January would be due then on February 15th, for example. As an employer, you have to pay that portion of CPP and EI. So CPP, you have to match the employee's contribution that's being deducted from their paycheck. EI, if applicable, is 1.4 times the employee's contribution. So important to keep that in mind. So again, tax registrations for PST in Saskatchewan, again, it's 5%. It will differ from province to province. Sometimes there is just that harmonized HST, which is GST and PST together, if you're in places like Ontario, for example. Generally collected on goods, some services, again, it'll depend. It is different than GST in that you have no input tax credits for PST, so you can't get a refund on PST that you pay. These ones, again, are similar to GST in that you can file annually, quarterly, or monthly, depending, and this is also done online. For Saskatchewan, it's done through the Ministry of Finance's webpage, that's SETS that I was talking about. Workers' compensation, as I mentioned, it's based on wages and the category or industry that the employee falls into. So if it applies to your industry, you'll want to make sure that you're registered. Again, I would recommend checking out your provincial workers' compensation website if that's the case. And those forms are due annually on February the 28th. So finally, just kind of to wrap up here, some administrative tips that I often will tell clients or people that are asking questions to prepare for tax season. Keep a mileage log. I had mentioned that earlier, and again, I know it's easier said than done, but if you are using your automobile for a lot of business purposes, it's really important that you are, being reasonable in what amount is actually business and what amount is personal when you go to claim those expenses. And in the case that you are ever to be audited, you would have to be able to back that up for CRA if they wanted to question you on that. Again, as I was saying before, penalties and interest on failure to file or filing late or not making your installments on time is really just throwing money away in a lot of ways if you're not on top of things from that perspective. So I always recommend that put those deadlines in your calendar or a reminder to make sure that you're staying on top of them and that you're remembering to file these things, because otherwise they can just kind of get lost in the shuffle of all the other daily tasks that you have going on. A question we'll often have people ask is how long should I be keeping my records in the event of a CRA audit? We generally recommend 7 years just to be safe. Really important, this one, keep business and personal expenses separate, and this will start to get a little bit confusing if you're a new start. If you've just recently started a business, try as much as you can, have separate, we often recommend separate credit cards. You have a business credit card for business purposes, you have a personal credit card for personal purposes. Instead of having a personal card, putting everything on there and then not getting to your bookkeeping for 3 or 4 months, do you really think that you're going to remember then when you're going through your statements, oh yes, this was a business lunch, I should take that out of my personal credit card statement, those kinds of things. So that will just make your life a lot easier. And then I also had put in there, be descriptive in your bookkeeping. So, if you make an entry in June for something and you don't put any description at all, or you put something that's not going to make sense to you 6 months down the line, you might go look back at that expense again or that entry and not know what you had meant to put there. So it's always better to be a little bit more descriptive than not enough. And then finally, set yourself a budget and monitor it frequently. I think that's just a really good common rule of thumb that'll allow you also to keep track of things and see where you are on a month-to-month basis. And a lot of accounting, off-the-shelf accounting software, that's a great option that you can utilize. So just a quick recap, again, the objective of today, I wanted to help you just understand how taxation works for your business, regardless of which structure that might be. And as listed here, we took a look at those business structures and how they are taxed. We talked a little bit about how to get company money if you're incorporated into your CANs as a salary, dividend, that kind of thing. Whether or not incorporation is going to work for your business, so we had touched on that as well. Some common business expenses we looked at, so again, that's capital cost allowance, automobile expenses, home office expenses. And then finally, I just gone through some administrative items for registering with GST, PST, workers' comp, as well as deadlines and kind of how to help you navigate as you move through taxes and bookkeeping. So with that, again, I'm available at the information listed here. Please feel free to call me at any time, send me an email. You can reach out to me also on social media. I'd be more than happy to help answer your questions. And we've got a few minutes for questions, so I'm going to take a look here just from the top and kind of see how I can help you. So the question was, can you deduct tips? So that would be for meals and entertainment expense. I would say yes, if they are reasonable, and just make sure that you're, holding on to those receipts when you're doing that business part of your entries. But again, it's that 50% that's eligible for tax purposes. So only 50% of that tip on that total receipt. The next question, can you write off GST, PST paid on your vehicle as input credits? So I would assume that would be GST and PST on monthly vehicle payments or monthly lease payments. I think I might have to reach out to you afterwards on that one. I just wanted a little more information on whether or not you're incorporated and what you mean by writing off. Okay, and then next question. As an RMT, I have shoes just for work. Would this be the same as meals and entertainment with the 50%? So when I think of this, for example, on the side, I like to teach spin class, and I am an independent contractor for that. Part of that required me to purchase special cycle shoes, and I was able to, when I filled out as a contractor my taxes on that, the income that I earned as a spin instructor, in that year I was able to deduct those shoes from my income as it was an expenditure required for me to do my job. So I hope that answers your question. I think it would depend on whether or not you're salaried or contract. If you're a contract RMP, you should be able to deduct your work shoes if those are required for you to, if it's reasonable and those are required for you to perform your services. Next question. RMT as well, you work out of an office that you rent, but you do all of your office work at home. So for this one, you should be eligible from the office perspective on the square footage basis if you have like a small office area in your home to deduct that portion. If you are needing to do, if you cannot do your bookkeeping and that kind of thing at your place of business that you rent, if there is no office space or it's just not feasible, and you can argue that you need to use your home space, you should be able to if it's considered reasonable. Let me look here. Okay, the next question, working from home, you pay your children to do some work for you, and then you write them a check and claim, or you're asking, do I write them a check and claim as a work expense, or do I need to set them up as an employee and make deductions? So again, it'll depend on their age. If they're over the age of 16, you will be required to consider CPP and EI. If they're under the age of 16, you should still be doing a T4 if you do write them up a check. You just won't have to worry about those remittances, but it is something to keep in mind if they are over that age of 16, then you do need to start doing the CPP and EI if you so choose. So that's important for you to consider with T4s, and the deadline again for that would be February 28th. Unless they're contractors or custom work and you want them to report it that way, but then it's important that they are reporting that on their personal income. Melissa is asking a question on PST. She charges PST on services at the spa as it's a service. Sorry, does not charge, but then is expected to pay PST on the products used during the service. So should I be charging PST to the service to cover that cost? I will have to get back to you on that one. I honestly am not a GST, PST expert on the fly, so I can look into that, and I'd be more than happy to get that answer back to you. Massage treatments to patients for a wedding gift. Is this the same as a donation to a business? So donations, when you make them for tax purposes, if you are going to claim them as a donation tax credit, they have to be to a registered charity that has a registered charity number. That can be actually looked up, I think, on the CRA website, so this would not qualify for that. It would be at your discretion. So a gift to a patient might be like an advertising cost for you, part of doing business to give back to your clients. It looks good for your business. If it was reasonable you would probably be able to claim that as a marketing or advertising expense. The next question was a reasonable percentage of income to use when contributing to an RRSP. So there's actually a calculation that is used when you're determining how much you can contribute. So it will take into account your employment income. And then I honestly can't think of the calculation off the top of my head. I know it's something to do. There's a calculation in there. I would love to get back to you on that. But you actually include your full employment income when you're determining that amount that you can contribute to your RRSP. And yes, Camille, I can talk to you about that afterwards. I'll have to look up the calculation. I can't think of it off the top of my head. If anybody has any other questions, I can probably take one or two more. If you think of any, please feel free to, again, reach out to me at that contact information, and I hope that the presentation was helpful for you. So thank you very much.
Okay, well, if there's no more questions, we can wrap this up. So first off, I just want to say thank you, Roxanne. That was a great presentation. Lots of good information in there for everyone. So definitely, I even took some notes, so that's good. So thank you for your time today and for sharing your insights into business taxes. We truly appreciate your time and all the information. I also want to say thank you to everyone that was able to join us on this webinar. Our next upcoming webinar is Advertising 101, and it's on February 15th, and our presenter is Daria Mallon from Boost Strategic Posting. So please check your WE emails or visit our website to register. And like Roxanne said, we're going to try and post some of these answers on the website afterwards.